Hello everyone, today we will present to you Orange SA, which is a French telecommunications company, together with my team consisting of Anna Carolina, Anna Beatrice, Dimitri and myself Mahmoud. We looked into the company and we think it's an attractive investment opportunity. Orange SA was formed following a merger with France Telecom in 2000 and is a company active in Europe, the Middle East and Africa. Its product offerings include 4G communications, enterprise solutions and mobile banking solutions. Mobile banking solutions are primarily offered in Africa and the Middle East, whereas the enterprise solutions are offered in primarily in Europe. And the communication services are active in over 28 countries, whereas the enterprise solutions are active in over 220 countries. This led to Orange having 125,000 employees all around the globe as of 30th of June this year. The main peers are primarily European and include companies such as Vodafone and Telenor. In many cases, they're primarily focused on Europe, but in some cases there's also a significant non-European operation or joint venture. Moving on to the last 12-month share price performance, we can see that Orange has outperformed its basket of peers by about 10%. And this is partially due to their experienced management team, which has over 20 years of experience combined at Orange. Moving on to the historical benchmarking, for the operational side, we see that Orange has underperformed compared to its peers, both on EBITDA margins and on profit margins, and this is also reflected in their valuation multiples. Now Beatrice will continue with discussing the historicals.
Orange sales increased by 2.5% and COGS increased by 5.1% over the last 3 years. As you can see, Orange gross profit margin has declined but remains relatively stable. EBITDA margin, on the other hand, increased by 1.2% due to a reduced staff expense. In line with the industry, Orange has a huge amount of PP&E, mostly towers, and intangibles like license, film, and music rights, so the firm will have large capex and D&A. Moreover, Orange has a goodwill of 26.9 million euros, so we believe that we'll have goodwill impairment in the future. Orange has a big amount of debt, which is common for telecom companies to finance their capital expenditures. As you can see in the right bottom corner, the reliance on short-term debt has increased from 8.6 to 18.7% as a percentage of total debt, primarily due to a long-term debt maturing within 1 year. Looking at the net debt to EBITDA, we can see that it has decreased to 1.99, which is relatively low to the industry and demonstrates its ability to grow the company's business if it takes on more debt obligation. Moreover, it showcases management's ability to deliver and meet their target debt levels. Finally, Orange Bank is used mostly for internal purposes, and its standalone income is close to zero, so we did not take into account in our validation.
Thank you very much, Beatrice. Now moving on to the cost of capital, we see that Orange efficiently utilizes BBB plus rating. We determined all the variables for the WACC calculation and chose to use Damodaran's beta instead of the market observed beta, as we found that the market observed beta is relatively skewed and is lower. As such, the weighted average cost of capital would not be in line with reality. For the market risk premium, the risk-free rate, and the cost of debt, we use a country-weighted average ratio, with the weight being dependent on the assets per country. And more interestingly, we see that the cost of capital is primarily sensitive to the capital structure and not so much to the cost of debt as the tax shield, as the interest rates are very low in the current environment. We will now move on with the assumptions and forecast of our business plan. Moving on with the forecasted business plan, we expect that growth in France will continue to be in the mature stage, and we expect a compound annual growth rate of 0.6% during the forecast period from 2017 to 2022. We moreover expect that mobile service will be declining, and it will be offset by an increase in equipment sales and fixed service. Moreover, we expect that growth in Spain will be in the moderate ranges, and that Orange will continue to capitalize and expand on its recent M&A activity in the country. As such, we expect a compound annual growth rate of 1.6% across all subsegments. We expect very strong growth for Poland and the other European countries, in line with their macro expectations for the major countries such as Poland and Romania. In the Middle East and Africa, we expect very strong growth, as these are emerging markets, which will see a higher penetration of mobile services, and as such expect a compound annual growth rate of 3.2%. And finally, for enterprise and international services and carriers, we expect that there will be a decline as voice services and data services enter the decline stage of the product. The above is also supported by the macro expectations for the major countries. France has notably not been able to benefit of the current cycle and has showed a stagnating growth. Real growth is expected to fluctuate somewhere between 1.6 and 1.8%. The African countries, on the other hand, most notably Egypt, are showcasing promising growth moving into the future, and this is also the case for Poland and Romania, which have respectively grown with 4.5% and 7.1% in 2017. If we model this all into our Orange specific model, we expect an increase of about 2 billion in sales from 2017 to 2022. Moving on with the bottom line of our forecasted business plan, we expect EBITDA to grow by 15.4% from 12.2 billion to 14.1 billion. This is primarily due to an expected decrease in labor expenses due to AI, which will replace labor, especially in countries with expensive labor such as France or Spain. And moreover, we expect that cost of goods sold will decrease as a percentage of sales by about 300 basis points to 19 billion in 2022, and sales are expected to grow by 480 basis points to 43.1 billion, as showcased in the previous slide. For the net working capital and capex assumptions, we used primarily historical averages, which were stable over the three-year average period. Other net working capital items include operational taxes, deferred income, and prepaid expenses. And as can be seen in the graph on the right bottom corner, capex does significantly is significantly higher than D&A, and we also use this in our terminal value assumptions in the next slides. Now Beatriz will continue with the DCF calculations.
Thank you. We calculate free cash flow to the firm for the years of 2018 until 2022. In our expectation, FCFF of Orange will increase in 2019 due to an increase in sales and further improvement of EBITDA margins, but we also expect a decrease in FCFF from 2020 until 2022, mainly due to capital expenditures and purchases of 5G license on building new towers. Orange will stabilize its FCFF on the 2022 level. Terminal value calculations are presented in a table below. The terminal growth rate is calculated as the weighted average telecom revenue growth forecasted in a company's main operating regions. We also applied mid-year convention as we assume that telecom business has a low seasonality and cash flows are received smoothly throughout the year. The implied enterprise value of Orange equals 74 billion euros. After net debt, associate and other adjustments, we got the market value of equity of 45 billion, what corresponds to 17 euro per share, with potential upside is 16%. We estimate Orange trades on 5.7 times 2018 EV to EBITDA, 12.8 times EV to FCF, and finally 1.8 times EV to sales. Move to multiple analysis. Orange valuation is at a discount to its European incumbent peers. This, in our view, illustrates the market's belief that Orange will be unable to stabilize group operation FCF in the coming years. However, we believe stabilizing mobile pricing in France, coupled with relatively successful cost-cutting across the group, should lead to Operation FCF above consensus expectations. Difference between implied DCF multiples and market median is not significant. To conclude, we base our target price valuation on DCF analysis. Market approach is considered only for illustrative purposes. We strongly believe that Orange will be able to stabilize its operation cash flow in the future. Despite the relatively slow growth of revenue, in our expectations the company will be able to benefit from further costing and automation of its processes. We expect slow growth in the current main market, especially in the domestic market in France. At the same time, Orange will be able to show a significant growth in developing markets in East Europe and Middle East Africa. Our recommendation is to buy.
Thank you very much
For your time.